Welcome back to the Investing Markets and Money podcast. And this week we're talking about the Golden Prospect Precious Metals Fund, which many of our readers will know has won an award in the Online Money Awards 2025. It was the Best Investment Trust for Growth. And one of the fund managers, Robert, is joining us on the podcast today. So welcome to the show.
Thank you. Thank you for having us.
You're one of the fund managers. You're from CQS New City, which is responsible for the Golden Prospect Precious Metals Fund. Can you give us a overview of the fund strategy, basically what it does?
Just a quick one. So I co-manage on 3 resources-focused investment trusts. So we've got Golden Prospect, we've got CQS Natural Resources, and we've got the Geiger Counter Trust as well. So, what the fund does, so, kind of does what it says on the tin. It's a precious metal-focused investment trust. So investment trust meaning it's closed-ended. It's about sort of 70 million in gross assets. So, that really gives us the flexibility to focus on the best value opportunities and the opportunities that we see in the market. So, within that, it means we're not chasing, the larger cap names that you see in the typical ETFs. It really, we think it's kind of small but perfectly formed, in that it allows us to really focus on the part of the market where we think we can deliver the best upside and the best risk reward.
So not the usual suspects like sort of the Barrick Golds and that kind of...
Yeah, no, we don't. Whilst we could, if we thought the time was right, but we don't own the likes of Newmont, Barrick, Agnico. We see far better value opportunities in the sort of small mid cap space. And just to be clear, for UK investors are often very cautious when they hear the word small. We kind of mean that on a kind of more global scale. So we really focus on names that are typically in that kind of 300 million to kind of $2 billion, $3 billion type market caps. So, proper companies, proper assets, solid management teams that have done it before.
And just mining stocks, no sort of associated companies or physical holdings in precious metals or anything like that?
So the mandate itself is pretty flexible, actually. So, we could do that if we felt that was the best risk reward. The reality is, if we look at the corporates, they trade at a material discount versus where they would historically versus the underlying commodity price. As a result, we think there's a very attractive risk reward in the miners themselves, over owning the physical, just on a relative basis.
Understood. And let's talk about the gold market. I mean, that's obviously done spectacularly well, and that's played a big role in the trust's amazing performance when you compare it with the rest of the investment trust sector in the UK. I mean, that's obviously how gold has done so far is history. So, from where you sit right now, what's your outlook for precious metals and in particular the gold mining sector?
So this is a big topic. It's a big topic, but I'm going to have to really try and heavily summarize it. I mean, if we just take a sort of step back of how did we get to where we are today? So, gold at 3,350 or so as we meet today. That's primarily been driven by central bank demand. And we really saw that in the post-Russian invasion of Ukraine, that we saw a real step up where central bank demand increased to around or over 1,000 tonnes per annum. So we think that's been the primary driver. We've actually had pretty minimal participation by general broader financial markets, generalists, even retail into the physical, just as a proportion. Where are we today? Firstly, we've got a US-led trade war with Donald Trump repeatedly, putting tariffs, putting trade war, putting restrictions. We think that's going to incentivize central banks to continue to buy gold going forward. But we think the real driver for the next leg up, because we're pretty positive on the outlook here, is going to be financial players coming back into the market. And, just to put some numbers around that, if you look around sort of physical gold ETFs, there's only about 300, it sounds a big number, but there's $300 billion worth of gold in gold ETFs. But relative to global assets, that's about 0.1% of global assets. In history, people have held 5, 6, 7% in gold in their overall portfolios. So we still think it's very much underheld. You can look to the likes of Bar and Coin, that kind of gets you up to closer to kind of 1% or so. But yeah, we think there's a load of scope to come through, and we think one of the real big drivers that's going to garner more attention is just around government debt sustainability on a global basis. And I could definitely spend some more time on this. I don't know if you want to go down that or not, but being conscious of time.
So if we go back to 2022, Russia invades Ukraine. Is it really the fact that the dollar was being weaponized as part of the sanctions regime that got these central banks to buy? Or is it because this is just the geopolitical risk scenario? Because a lot of analysts I see today, and they're more generalist analysts than specialist commodities analysts, are saying, oh, geopolitics is looking a little bit shaky. That's what's driving the gold up. But part of me thinks, no, it's the central banks just wanting to shift more money into gold, just from a purely, I don't want to hold as much dollars policy mission.
Yeah, so I mean, it's central banks, so it's not speculative traders that we've seen, and it's interesting. If it was more speculative traders, and we're seeing that showing up in some managed money futures, etc., then I'd say maybe there's a bit of a war premium. We just didn't really see that. It was all central banks, and that coincided with an acceleration in the sell-off of foreign-held US Treasuries and a pickup in building gold reserves. And if you look at the countries that led that, China was the largest as a proportion. So it's pretty clear that this was about weaponization of the dollar. It was the fact that the US basically blocked Russia's access to treasuries, which are ultimately an IOU to the US government. And yeah, they'd rather own something that isn't controlled by a foreign state, particularly one that's not acting in an overly friendly way, putting trade wars and tariffs, etc. So yeah, we think that incentive. You look at Chinese gold reserves; they're still well short of what you'd see in the likes of the US, where it's around sort of 20% of reserves at kind of mid-single digits. So yeah, we think there's a real scope for further additions to increase that, because it gives them that defensibility in their own reserve structure. And why would they want to be sat there owning US Treasuries, given the backdrop that we have and the reactions that they've seen? So ultimately it's about trying to increase their leverage within trade negotiations and their leverage as a country, and also protecting against actions of other foreign states.
And you get a lot of chatter about, for example, recently we've had the peace talks with, preliminary peace talks in Alaska. There was a lot of speculation that if a deal came out of that, the gold price would drop, because again, we see that geopolitical risk argument coming through. But certainly the reason why I'm long gold isn't to do with that. It's to do with the fact that I think the whole monetary situation is shifting globally. That's got nothing to do with geopolitical risk. It's more to do with central banks just rethinking how they want to hold things ultimately.
Yeah, well, nothing's ever completely binary. So it's never is it or isn't it. Yeah. It's kind of to what extent are people factoring that in as a factor. I very much share your view. Our bullish thesis is more about the sort of macroeconomic backdrop. We didn't see kind of massive spikes in gold per se around the war, like you maybe did around some of the early days, but we don't think there's a huge kind of premium for that. So yes, if a ceasefire was struck tomorrow, you'd probably have a red day and a down day in gold, almost certainly, and that could be people genuinely owning it for that, or it could just be the perception of a heightened risk of that. But I don't see big shifts. I really don't see big shifts on the back of news flow like that. I think what may have more near-term impact would be kind of around US rate decisions. So we've got Jackson Hole underway in the US currently, and there's a lot of chatter there around whether the US Federal Reserve will cut rates or whether they'll stay flat, and everyone's highly focused on current data coming through. Inflation's clearly proving to be sticky. Jobs data is now weakening. There's a real thesis there around whether we see rate cuts or not. Our view can change daily, but I think we're probably more of a view as they seem a bit more concerned by inflation than they do softening job data. So our view, and by the time this goes out, I could clearly look out of date, but our view is they're probably more likely to stay flat in the near term. But then ultimately, with President Trump trying to get trying to oust Fed Chair Powell, or at least kind of neuter his control and influence over the Fed, that ultimately it is looking like a potential for rate cuts in the future is increasing, whether that's under Powell or whether that's under next appointed chair. We will wait to see. But our view is actually either side. I don't think it's necessarily that negative for gold, because if rates come down, gold is expected to trade well, just because of that historic relationship. But actually, if rates stay high, then you then get into the question around US debt sustainability, high interest costs. They're more sort of shorter dated maturities rolling over into current, and ultimately pushing up their interest cost on US debt up to, which is currently around 1 trillion per year, up to about 1.8 by the end of the decade, about 1.8 trillion, which is huge when you look relative to an overall tax take of 4.5 trillion, just to put that in perspective.
No, absolutely. And I wanted to ask you, you're talking generically about gold here. Obviously, someone could go and buy a precious metals gold ETF. What's the added value that an investment trust like yours brings to the table for them?
Well, firstly, we are focused on different names from an ETF, but really, I think what the value add that we bring is experience and knowledge. I'm a geologist by education, so I get quite technical with understanding the asset itself. Keith, the co-manager on the fund, he's more physics background, so he gets kind of quite technical on the processing side of things. But ultimately, the biggest value add that we probably bring is, I've been doing this over 20 years. Keith's been doing it over 30 years, and it's knowing many of the assets in their prior guises, knowing the management teams that you really want to back and listen. It's often the ones that aren't shouting the loudest, trying to raise money and get new investors in. It's actually the ones that are quietly just actually doing the day job in the background and executing. So it's taking that expertise. It's having the flexibility that we have within our mandate to focus on names that we think offer the best value growth going forward. Flexibility to position ourselves either, all-in producers, or we could increase the developer positioning, or even go explorers if we feel like that offers the best potential. So, that really differentiates relative to the bigger ETFs, which ultimately just allocate pretty much based on liquidity.
And does that involve having meetings with company management, going to see the mines, looking at the samples they're coming up with, stuff like that?
Yeah, so we do a lot of meetings. We do like a lot of company meetings. I'd say, hundreds per year. And one thing that actually kind of came out in the sort of post-COVID world is that actually, as sort of video meetings suddenly became kind of more acceptable and sort of accessible in a way. So actually, what we found is we probably have even more meetings now, but kind of shorter meetings. It's much easier to meet the wider team. We've both done many site visits, and I would argue actually one of the biggest benefits of doing site visits is actually meeting the wider team, really understanding the kind of depth and general support for it, rather than just meeting CEO and CFO, and you get a much wider or much clearer base understanding of what's behind it, rather than a CEO in some cases might be a bit more promotional. So that can be one of the real value adds. And actually, given we can now do video meetings, you can actually meet wider teams. You can kind of run through, geological models. You can kind of map things out. So it lessens the need for site visits in a way, but there's nothing quite like boots on the ground to actually go and check that the locals haven't sort of blockaded the front of a mine and protesting against it. Protesting against it existing, whilst the CEO telling you that everyone's very supportive for jobs.
Right, yeah.
So there's two sides to it, but it's always it comes down to what's the most efficient use of time and where do we add the most value for shareholders and ultimately performance.
And how do you manage risk in the fund?
So I'd say we're more risk tolerant. And I say that because I think there's always a price for it. People are very quick to say, "Oh, I won't invest in Africa for said reason," or "I won't invest in a certain area," or "I won't invest in a certain commodity because it's not in favour." Where our view is there's an effective price. There are some countries that we just sort of flat out ultimately avoid, but they're pretty few. Like taking West Africa for example. You can look at we own a company called West African Resources based in Burkina Faso that went through a coup. It's been through multiple coups before, but it's that kind of deep understanding of that actually they're located south of the capital, which makes them far safer than the Mali border up on the northern, up at the north, which is more exposed to security risks. The coup aspect itself, actually, is a country that's heavily reliant on mining for generating jobs and bringing dollars into the country. So, even under a new regime, would remain very supportive, and has a wide mining industry, so it's been safe to operate. So, with all that backdrop, the point is, what's an appropriate valuation discount? And it's trading at around a third of what you would perhaps get in a comparable company if it was, say, in Australia or the US. Where actually, if you look to Australia and US, there's different risks. So people think about risk around, expropriation risk, where actually the risks are far broader than that. And actually, we've had, many of the slip-ups we've had have actually been down to, high labour costs in the likes of Australia, where in the post-COVID world, actually that led to really tight labour and really bumped up costs for many of the producers. It's things like that. Or in the US, historically it's been actually they've been quite slow on getting permit extensions or changes and allowing a mine to operate. So it's never quite clean. It's very fluid. It evolves, and yes, so we have to kind of assess everything relative to price and ultimately the risk, and therefore and also position sizing.
So there's a big political element to running a trust like that. It's not just about has this miner taken on too much debt or anything like that.
Yeah, it's huge. I'd say we probably spend about a third of our time on the kind of general geopolitical macro side of the global economy, and almost comparable with the actual bottom up side of it, which is actually analyze companies, getting into the details of understanding the assets. Because if you get the top bit wrong, then the bottom bit doesn't even matter.
Yeah, and what's the geographic exposure like of the portfolio at the moment?
So at the moment, we've got quite a heavy Australian weight. We have taken in the African exposure, West African exposure slightly, although still have a more material, still have a sort of material exposure. But I'd say predominantly it's going to be North American weighted. We like Latin America, but probably a larger weighting to the Australian miners than we have historically. And that's down to our views on the reversal of those issues I was talking about before with high cost inflation on labour. Actually, we see that reversing. We see a lot of room for consolidation. We see a lot of room for M&A. We think our names are well placed, particularly in these jurisdictions.
And I know we've been focusing largely on gold on this discussion so far. Do you guys spend a lot of time looking at the other precious metals markets as well? And what's your view on those?
Yes, we do. They're quite different drivers, as we all know. So silver's the obvious first one to look at. People talk about silver as being kind of gold on steroids. I think we're kind of in a slightly different world where, it's over 50% industrial now. Mm-hmm. Yes, that ties into some very strong growthy areas because silver is the only metal that's a better conductor than copper. Electrical conductor. So as a result, it's used in the likes of EVs, wind turbines, solar panels, and undoubtedly will be used in sort of AI and some high-end chips, although we don't have any hard data on that. So there's some nice growth size to it, but at the same time, it's quite speculatively driven. And I think we're seeing a sort of similar trend across a lot of the other metals. So people are looking at gold saying it's been very strong. Have I missed it? Well, there's these other sister metals that we can play, and there's a catch-up trade to come. I think we kind of take a view that, and we do own quite a meaningful amount of silver miners within the fund. But we kind of take a view it's slightly different dynamics. I have far more conviction around sort of central bank demand and ultimately financial players coming in looking to add gold to add protection against potential fallout of the broader macroeconomic issues that we were talking. Silver feels like it gets a bit more of a kind of retail, particularly kind of US retail, kind of meme stock. You see quite a correlation there between sort of crypto and silver within trading. And PGMs, really interesting. We had PGM week not so long ago, and then we saw a rally kind of stem post. One thing we'd been looking for was more producer discipline within PGMs, and actually this price spikes actually pushed that out. So we haven't seen that discipline because it was an industry that was really deep into its sort of cost curve on production. So we'd been kind of cautious around the miners specifically. But I guess that all kind of feeds back into us being kind of fairly cautious around what the outlook for the global economic backdrop is. So, we think we're in quite a stagflationary world where we have slowing growth, weakening jobs. If anything, AI is just going to exacerbate the jobs issue because we're seeing people being replaced. That ultimately isn't a good backdrop for industrially led metals. So that leads to a degree of caution. That said, if you get these speculative flows, you can get very strong moves into the metals, and silver and the likes of platinum have actually been in deficit for the last 4 years. So there's many reasons to be bullish. I'm just not sure it's any more bullish than it was a month ago today. If anything, I'd kind of be a bit more cautious because the rally we've had in the likes of platinum can actually slow some of that producer discipline that we were anticipating.
And we've talked already about company engagement and going on company visits. What do you do as a team about looking after issues like sustainability and corporate governance within mining companies? Because the sector has had a bit of a checkered record in that area.
Yeah, it gets a lot of rap. I would actually argue long before ESG was an acronym on the tip of everyone's tongue, that miners have had to operate. And there was always examples where this hasn't been the case, but they've generally had to operate to very high standards. Otherwise, they run the risk of either government shutting them down or the local or locals protesting and stopping access to the mine. So ultimately, they've had to operate in to higher environmental standards than are often required in the country that they're operating. Because if they don't, they run the risk of, firstly, upsetting Western investors. So we very much expect the highest standards in both processing, water management, remediation, how that's left post, in as much because it's a good investment. Because if you're not paying taxes, governments are going to get upset and you risk expropriation. If you're a very good taxpayer and essential to the economy, then you're likely to see support. And the environmental aspect's obviously huge. So we think the miners have got a bad rap, and there's clearly some bad examples out there. But really, if you look at most of the mining damage that's been done, it's nearly all been illegal miners. So the likes of artisanals and some bad operators that aren't under aren't listed equities that are under a much more stringent sort of microscope.
And I guess there's always the risk that a government sees a gold mine as a gold mine, effectively, don't they? We've seen some situations recently, for example, in Africa, where gold miners have been under pressure.
Yeah, in Mali. So, Mali's a specific one. So, we were talking earlier about Burkina Faso, and Mali is one that we don't have any positions in. And that's because we don't have confidence in how that coup government are operating, and that you are effectively allowed to make money. We've seen Wagner in country. Chinese were sort of heavily in there. We think it's quite different, potentially a higher risk for Western miners. And we've seen that kind of follow through with Resolute CEO being effectively imprisoned, or prior CEO effectively imprisoned for a period, given debate. And it just shows how high the stakes are effectively. We've had Barrick writing off their asset in Mali, given issues there. So, it does show that there are risks, but understanding those and the nuances to it and how that plays out is kind of one of the key in-depth things I think we offer to investors.
We've given you the award for Best Investment Trust for Growth, just to recognise that.
Yeah.
How do you balance that? Because that's a very strong showing on the growth side of the fence. Are you able to also generate income for the fund or for investors on the other side as well?
Yes, we don't pay a dividend. We aren't income. We're very much total return focused rather than income focused. I'd say as a sector, balance sheets are as strong as they've ever been. Free cash flow generation is probably as high as it's ever been. And the scope for dividends and buybacks is material. So far, what we've seen is material percentage increases in dividends, but off very low bases. So, still pretty muted dividends overall. I think buybacks are likely to be more of a focus, given that's generally the pressure in North America, given the sort of tax implications of income relative to capital gains. So, certainly, given that's where the bulk of global resources money is coming from North America, that's likely the route we end up seeing. What I would say within our portfolio, and again, this comes back to the point of fluidity within the structure. We really like development assets, but we're also very cautious around development assets that then miss and ultimately end up losing a lot of their share price because of the perceived risk. So we're very heavily weighted currently in producers with development assets, and you'll see that across our top 10, because firstly, you get the de-risking of having a producing asset into a very strong gold price environment, generating strong returns, and a development asset that we believe is underappreciated. And I say underappreciated because there are cycles you want, or points in the cycle you want to be in development assets, and points in the cycle you don't. We believe we're in a market where it's getting easier to build mines because because a lot of other mining sectors are struggling, or people simply aren't building new projects. So that means you're getting good build teams, the A team on the build side. Steel prices are low, energy's low, labour's really easing up, and that really de-risks the actual execution around bringing these mines on time, on budget. So if you do that with the safety net of, if there is a slip up, and whenever anyone who's had any building renovation going on knows that you start with the price that you expect it to be built at, and there will always be some add-ons. And it's kind of rare that the mining projects similarly ever quite completely come in on capex, and it's always very impressive when they do. But you generally get some slippage, at least in part just down to sometimes it's nice to have add-ons or things that you kind of realise as you're going through the project that would improve it. So that's why we like having the producer, but with the development asset, and we also like, we call it value with catalysts. So we think that's very much value with catalysts. So as these projects come on, the story de-risks, and ultimately that becomes a catalyst that then adds to that further upside.
Yeah, I like these ones too, because you've got they're already making cash.
Yeah.
They're a gold miner or a silver miner in an environment where prices are really high, and so they've got the money to do that extra development. Whereas if they are just a developer and they're just relying on their existing treasury, they're burning through that money really quickly.
I mean, just to put some numbers around it, the large cap producers will often trade around at 1.4, 1.5 times price to NAV. A single or two asset producer will trade around 0.7, 0.8 times price to NAV, and a developer will trade at 0.4 times price to NAV. So very loosely. But the point is, if you're a developer that transitions to producer, you get that kind of material upside. But if you're doing it, because then it'd be blended if you're a producer with a development asset. But it's that ultimate multiple uplift, as well as getting to scale, that ends up, we think, being a kind of material driver over and above just what you get as a look through from the gold price.
And do you ever, I know some mining investors do this, do you ever look at a company and think, that looks like a good takeover target, one of the big boys is going to swoop in on it and the price is going to the moon? I mean, that's something you see a lot of smaller investors doing, but is that something that fund managers think about as well?
I mean, it's something that's certainly in the back of people's mind. I'd say we've never really taken that as a view, or as a key driver of making an investment decision. I think that's the way of putting it. And in part because actually, you've got to go back to the prior cycle to where you saw really lofty premiums put on takeout targets. Actually, a lot of the M&A we've seen has come at much smaller premiums. It's been more of a 1 + 1 = 3 type mergers. So, single asset producer merging with another single asset or two asset producer ends up getting you to scale, gets you into that ETF inclusion and greater liquidity, means that you transition from that kind of 0.7 NAV up to kind of a one times NAV, and that can be how you kind of how you get the increase. So yeah, M&A, but then inherently our kind of view on, or our approach on focusing on that, 300 million to kind of 3 billion type range does mean that we've actually had a lot of M&A activity on our names. So, focusing on really good geological assets, good management teams that have developed them well, brought them online, ultimately makes them an accretive target. So if you're a larger producer on a premium multiple, you can pay 20-30% premium for a junior and it still be accretive to your effective share price, because you're trading at a higher multiple, especially if it's all done with paper. So, it's something we've seen. Of our top 10, I think four have been taken out in the last 4 years. Sorry, in the last couple of years. So 4 in the last couple of years, and actually, in many cases, we actually still own them because we like the acquirer, or in some cases, we've exited and chosen to move into other names. So, yeah.
And you mentioned ETFs just then as well. You've mentioned a couple of times on this interview. Obviously, you've been in this market for quite a long time. There's 2 decades in the market. How's the ETF market impacted your side of things as buyers of precious metals? Have you seen any changes there?
Yeah, I mean, it's affected everyone in any fund manager in any sector. I mean, there's just been this steady shift from actively managed funds into passive, and that's been like a steady headwind against the sort of more active strategies. I would argue that we're kind of getting more towards peak kind of passive saturation. It's clearly created quite broad, quite wide valuation discrepancies, and when you get to that, it ends up driving, as we're saying there on M&A, or there's a real shift in effective risk reward just by going up liquidity rather than sort of focusing on these active strategies. So yes, it's shifted things. We don't kind of view it. I'm not going to sort of complain about it. I think it actually creates some opportunities. We talk there around investing in those names pre ETF or index inclusion, and then when you get them, you get this real extra kicker of just program computers effectively coming and buying names because they've gone into an index and effectively adding some additional upside. And you do see outperformance of those names when you go through those transition periods.
Interesting. And before we finish, I wanted to ask you about this subscription shares rights issue that you guys have coming up on the calendar. Can you tell us something about that?
Yeah. So the fund has each year it's had a 1-for-5 subscription right. So that gives shareholders the option to buy for every 5 shares they own to buy 1 share at the NAV at the start of that period. And this was set around early December, and this one will expire in December this year. So all holders of the fund will need to put in, and generally for most of the platforms will need to put in their vote around a couple of weeks before. Given the strong price action in the fund, those options are now well in the money. So at 48 pence. So we just want to make sure that investors put a note in their diary and don't miss that, because it's a great opportunity to get back into the shares at a discount, and if you don't participate, would be potentially dilutive. So I just want to make sure that people don't miss that.
Yeah, that's very important. It's a mistake even I've made in the past, is keeping tabs on the corporate calendar for the investment trusts you're with, because some very interesting opportunities can get missed that way.
Yeah.
Fantastic. Thank you very much indeed, Robert, for joining us on the podcast this morning. It's been very, very interesting.
Thank you.
Thanks a lot.